While you blinked, 1,000 trades just happened. Welcome to the world of high-frequency trading, where time is literally money. But governments want to pull the emergency brake. They're proposing new HFT taxes to stabilize the system. Will it work or dry up global liquidity? Today, we're doing a deep dive into HFT tax proposals and the lifeblood of the stock market, liquidity. Let's get into it. HFT isn't trading by humans, it's trading by lightning-fast algorithms. Firms pay millions to co-locate their servers near the exchange core. Firms have laid dedicated fiber lines across oceans and bored through mountains just to be microseconds faster than the competition. The race went beyond fiber. Firms built networks of microwave towers to beam data through the air, which is even faster than light through glass. Liquidity is the lifeblood of the market. Think of it like water. When there's plenty, trade flows smoothly. When it's gone, the system grinds to a halt. HFTs act as the ultimate middlemen. They constantly quote prices, narrowing the gap between what you want to pay and what you get. By being on both sides of the trade, they provide market-making services, ensuring there's always a price available for you to buy or sell. They also use arbitrage, detecting tiny price differences for the same stock on different exchanges and closing that gap in milliseconds. Critics, however, argue that HFTs create ghost liquidity. It's there when things are calm, but it vanishes the second things get risky. We've all seen the flash crashes. The 2010 event saw $1 trillion vanish in minutes before recovering. Many blame the algorithms. Some critics point to predatory strategies like latency arbitrage or scalping, where HFTs profit by front-running slower investor orders. Enter the Robinhood tax, a tiny fee on every transaction. It sounds small, but for HFTs trading millions of times, it's an existential threat. Governments have three main levers: a direct transaction tax, fees on canceled orders, and penalties for ultra-short holding periods. Message fees target the noise. HFTs submit and cancel thousands of orders just to test the market. This tax is designed to stop the spam. Holding penalties literally tax speed. If you sell a stock less than a second after buying it, the government takes a bigger cut. History gives us a warning. In 1984, Sweden introduced a transaction tax. The result was nearly catastrophic for their local market. Within weeks, 60% of trading in major Swedish stocks moved to London. The tax didn't raise revenue, it just moved the business. More recently, France and Italy introduced their own taxes. While they didn't collapse, trading volumes fell by up to 20%. In Milan, the impact was felt across the Borsa Italiana as market participants adjusted to the new cost of providing depth. Revenue was lower than expected and bid-ask spreads widened, making it more expensive for everyone, even long-term savers. But there's another way. Exchanges like IEX use a speed bump, a physical coil of fiber optic cable that delays every order. By adding 38 miles of cable, they create a 350 microsecond delay, making predatory HFT strategies impossible without a tax. But here's what many don't realize. Your free retail trades are often paid for by HFT firms through payment for order flow. If you tax the HFTs out of existence, that revenue for brokers disappears. Your zero commission trades could suddenly cost $10 again. There's also a risk for smaller companies. Their stocks are already harder to trade. A tax could make them so illiquid they effectively freeze. Pension funds and retirement accounts also suffer. Wider spreads act as a hidden tax, eating away at returns over decades. Then there's the world of dark pools, private exchanges where trades are hidden from the public until they're finished. If you tax public exchanges, HFTs and big institutions might move even more of their trading into these dark, unregulated corners. Academics remain split. Some studies show volume drops of 20%, while others suggest that overall market quality actually improves. The ultimate fear is a flash freeze, a market so heavily taxed that no one provides liquidity during a real crisis. That's when things get dangerous. Our markets are more connected than ever. A tax in New York can trigger a liquidity crisis in London or Tokyo in milliseconds. It's a high-stakes balancing act. Tax too much and the market dies. Tax too little and you haven't fixed the instability. Some argue we should tax the behavior, like high cancel rates, rather than the trades. It's a more surgical, less destructive approach. Ultimately, this is about sovereignty. Governments want a piece of the digital pie and more control over a world that moves fast. As AI becomes fully integrated into trading, the line between HFT and standard investing will blur. Speed won't be the only factor. The tax proposals of today might be obsolete tomorrow as AI reshapes the very nature of how we define a trade. So, what do you think? Is a small tax a fair price for a more stable market, or is speed too important to mess with? Let us know in the comments. The global stock market is at a crossroads. The decisions made by regulators today will define the liquidity of tomorrow. Speed isn't going anywhere, but how we value it and tax it is about to change forever. Stay tuned for more insights. HFT tax proposals are more than just revenue tools. They represent a fundamental restructuring of how our markets function. In the end, liquidity belongs to all of us. Protecting it is the ultimate global priority. Thank you for watching this analysis. If you found this breakdown helpful, please subscribe to our channel. We bring you deep dives into the forces that shape our global economy. And don't forget to hit that like button. It really helps the algorithm recognize that long-form financial analysis has a place on YouTube. I'm your host. Good night. We'll see you in the next analysis. Keep an eye on the numbers. Take care. Thank you for joining us for this deep dive. I'm your host. Good night.